Today we're going to be looking at the net wealth finance strategy to become a millionaire in 9 years. Now this is just a scenario that we came up with for this example. You could have a different savings rate, different age. If you have a scenario that you want us to walk through for your age, income, and savings rate, drop a comment below. We'd love to check that out and walk through something that's more realistic for your scenario. But we're going to be looking at a 30-year-old making $100,000 per year with a 48% savings rate. That rate might sound really high to you if you're not familiar with something like the FIRE movement or financial independence, retire early. But really, this is a realistic savings rate for many people, and many people do target a savings rate like this or even higher if they're FIRE adherents. And really, it's not necessarily about retiring, like you're going to stop working. We're really looking to create financial independence so that you can kind of choose what you might do with your time rather than working to sustain your lifestyle. So in this example, we're going to walk through using an IUL combined with the BRRRR strategy of real estate investment. We'll talk through what that is here in a moment. And we're not even including the extra cash that you generate from your real estate investment activities in this example. So you could actually achieve financial independence a little bit earlier if you were reinvesting the extra cash flows that you generate from the real estate using this strategy. So the BRRRR strategy of real estate investment is a strategy in which you buy real estate, you renovate it or rehab it in order to generate what's called forced appreciation. So you're adding value to the property. And ideally what you do is you add value beyond what your costs were in total. So, targeting every dollar, maybe getting you a 2-to-1 rehab dollar to value, 2-to-1, 3-to-1 sometimes, depending on how you do that. I'm not going to go through all of how you might do that in this video. You can check out our channel for our strategy on BRRRR real estate investment, where we walk through the details of how you might achieve the rehab and this kind of return. So after you finish your renovation on a property, so generally speaking, you're buying a property that needs some work so that you can renovate it, and in order to get it below what would be market value after the rehab. So once you're finished with that, you rent out the property, and so you're generating cash flow on the property, and also you can substantiate using that rental income to do a cash out refinance. So once you've cash out refinanced, you would take those funds, pay back your loan against your insurance policy, in this case using the net wealth finance strategy, and you repeat this process. So let's get into a couple of other things. This page here is a retirement calculator. So let's just say you were going to calculate your time to financial independence using what is a more normal market investment strategy. So looking at an annual return on investment of 8%, and you could probably retire in about 15 years or have financial independence in about 15 years. So if you want to check out this calculator, you can look at the video description. We'll have a link to this calculator, and this you could use and tweak these numbers for your specific scenario. So if you assumed a 10% return, your retirement age or your financial independent age or time frame is reduced to under 14 years. So this is just a quick example. 8% is a good number because you can sort of factor in inflation when considering for normal market investments. Now, we fully support using market investments. We have market investments in retirement accounts and brokerage accounts. So there's nothing wrong with that. Today's scenario, we're not walking through that. So this is just for demonstrative purposes to look at the numbers for if you were saving this similar amount and using market investments. One of the main advantages of an IUL and the net wealth finance strategy is the concept of an indexed loan. Now, if we use whole life, we don't have access to this same concept, and they're great. There are some advantages to using whole life insurance over an IUL. I'm not going to talk through that today, but within an Allianz IUL, we have access to borrow at a rate of 5% annual interest, and those funds that we borrow against can continue to earn based on the index performance. I'm not going to walk through all of how index crediting works. Again, we have another video on that. If you want to check out that video on our channel, we can go into we have details on how index crediting works. But effectively, we have downside protection where we might have a floor of either 0, 1%, or maybe we're using one of the asset charge ones. So the worst case scenario, you could have a negative 1% charge on the funds that are allocated to index strategies. But we can always borrow at 5%, and if the index strategy earns 6, 7, 8, then we'll get credited based on that indexing strategy while borrowing at that 5% rate. So you have the opportunity for arbitrage within the policy. Now, you do have access to these other loan structures. We don't prefer those for most circumstances because you lose access to that indexed strategy that is in the IUL policy, and that's one of the powerful features of an IUL is to have the indexing available. So in years 1 through 10, you get charged 2.91%, and your policy gets credited 2%. So you have a net cost to borrow of 0.91% on those funds against the policy. In years 11 plus, you have access to a 1.96% rate, and your policy is credited 2%. So this is what would effectively be called a wash loan, and many whole life policies might have an equivalent with a wash loan. Now, another thing, the assumption in this scenario is we're assuming a 6% crediting rate with the policy. So in this case, we're looking at an Allianz IUL, again, assuming a 6% crediting rate. So over since 2006, these are the numbers that Allianz publishes, it makes public. The IUL policyholders have received a credit of 6.15. Now, I think that the products have improved, and I think that crediting rates should probably outperform this, but obviously none of this is guaranteed because there is a market element to an IUL. That's indexed universal life. We're not going to get into details of what that is. We have other videos you can check out on our channel about how the crediting works within an IUL. But today we're just going to walk through a sort of assumption of a 6% crediting rate in the policy, which I think is realistic and conservative, but again, that's not guaranteed. Let's take a look at today's scenario. So we're looking at a male, this policy being started at age 30, and we're putting in $48,000 per year, and we're combining that with the strategy of BRRRR real estate investment. So in the first few years, we're just letting the cash value build up, and you don't have to wait for that. You could start real estate investment or other investments in years 1 through 4. The software that we use does not actually allow for illustrating loans before year 4, but you can take loans before that. So again, you could accelerate this time frame if you wanted to start investing in real estate earlier. So the column here is the policy's annual premium outlay. So we're showing $48,000 per year. The net distribution is either loans or demonstrating income. The total loan charges, so this is the interest that is being charged, and the accumulation value is what your crediting is based on. So for this $48,000 that has gone into this policy, the crediting rate will be based on $45,000. So you factor in the cost of insurance and other things like that, the expenses that are inside the policy. That's what your accumulation value is. The cash value is your net cash value. So this is the amount that you can borrow against. Generally speaking, it's around 90-95% of your cash value that you can take loans against in an IUL policy. And here's your death benefit, just really for illustrative purposes. So this net worth here is just assuming what is in this policy and what we're looking at here. We're not considering other investments and other things that might contribute to your net worth. This is really just considering the IUL policy and the real estate investment that we're going to be doing in this walkthrough. So the rest of the columns, as we get into the real estate or cash flowing assets side of this, we're this, again, could be maybe you're an entrepreneur and you're doing business investments. The scenario we're walking through here is using the BRRRR strategy of real estate investment, where we buy properties, do forced appreciation. So that's what this column is. And then we cash out refinance to pay back our original loans, and we'll keep a loan with the bank. We'll have a bank for the loans, and that is where we'll make our payments on our mortgage for those properties. But this will allow for us to kind of continually reuse the same money. So in this scenario, we are showing using the money to purchase a property basically every year for 8 years. So the first example being $141,000, and the second one. So really, this is just for illustrative purposes. You might be able to get bigger loans or smaller loans, or borrow against your policy slightly higher and do slightly different numbers. But this is the asset acquisition costs that is considering for closing costs, the rehab, all of that. So maybe in this first example, we're buying a property for about $100,000, and we are doing around $30,000 or $35,000 in renovation costs, and $6,000 or so in the closing costs and other costs that might be involved in that purchase. So in this scenario, we're looking at using a 40% forced appreciation rate. So that's after you do the renovation on the property, the cost of the acquisition plus your renovation, adding forced appreciation of 40%, which is a realistic target. If you're already a real estate investor and you want to see numbers that are realistic to what you're seeing with forced appreciation, drop a comment below. We could walk through the numbers for what you're seeing in forced appreciation, but this is just for illustrative purposes. So with that, this number here is factoring in that forced appreciation, which results in the ability to get a cash out refi for this, in this case, 80%. Maybe you're looking at more like 75% of cash out refi, but in this case, we're looking at 80% of the property value being taken back out as a loan. So again, if you want to see numbers specific to what your lenders currently allow, drop a comment below. We could walk through numbers with that scenario. The value here is when we do that cash out refinance, we're getting out $156,000. Our acquisition cost was $141,000. But this cash in excess of policy loan is actually also factoring in the interest charges. So we have interest charges on that loan. So when we pay back that loan, we are actually going to pay back that interest. So this is sort of assuming that our holding costs were for the full year. So we're paying that 5%. This policy has the ability to do a 5% indexed loan. So we continue to see the crediting based on the index performance in this policy for the IUL, and we're paying 5%. So this illustration that we're walking through is showing holding that note for the full year. Now, if you're a real estate investor and you're doing the BRRRR strategy, or maybe you're a flipper, you probably know that your holding costs are not going to be for the full year, but we're sort of taking a conservative approach here to say that we are not going to hold. We're going to hold that loan against the insurance policy for the full year at 5%. So this is extra cash that is generated as a product of getting that cash out refinance and paying off the loan to the insurance company. The assumption that we're working with here is basically the historical average of real estate appreciation. So 3% is a realistic historical average for the growth rate of the real estate property value. And again, this column here is the asset's total value. So the total value after our forced appreciation, but this column is actually the total combined value of the assets that we have in our portfolio, specifically the real estate assets in the portfolio. So this column here is going through principal paydown. So when we have a mortgage, so this principal paydown is the mortgage with whatever our lender is. You might use a DSCR loan, debt service coverage ratio loan, so that you don't have to tie up your own credit. And this is the principal paydown is sort of an extra savings that you are doing when you're doing real estate investment with the BRRRR strategy. The mortgage balances are here, so this is sort of factoring in that principal pay down over time that you have, and then the total equity. So this is what adds to your net worth, and how your net worth is calculated. So moving on to some of these other columns. Now, cap rate is a term that we use in real estate investment. So the cap rate is a percentage of the asset's value that becomes your net income. So now that calculation is with cap rate is going to be before debt service. So this is the amount that you are paying your cash flows prior to debt service. So when you have a mortgage on the property, you're going to be paying that mortgage. So most of this income in the early years is going to be going to just paying the mortgage. So let's just say we have this first property, the income is $11,872, but if we look at its monthly payment on this property, it's $995. So this is factoring in some things like property management, taking 10% and accounting for vacancy and other things like that. But that's what we have pages for each of the properties here and how all of this ends up being calculated. So really, actually, in year one, this particular property is not really cash flowing at this amount with 6.5% interest rate. But again, we could tweak these numbers with various things. So your mileage may vary on what you're doing for cash flowing, but this is sort of considering for a negative cash flow scenario, but in these other properties, we start to generate actual cash flows. And so that's what's shown here. We have positive cash flows going forward. And then we're looking at total cash flow. So later on, we do go, after about 21 years, we're going to take an income from our IUL policy. So that goes in addition to our real estate investment income. So that's the gist of this scenario that we're walking through. And now the center column here, this net worth column, that is in green, this is the net worth when considering for the cash value inside of the IUL policy and the real estate value that we have in the properties that we use with the BRRRR strategy of real estate investment. So in the first few years, we're not factoring in any kind of equity in the properties. You'll see that it drops down. This is just the way that we're calculating it. It's not technically dropping down, but really at any point when you're outflowing, doing rehabbing, your net worth might sort of drop down on paper because you're outflowing, paying contractors, and you haven't cash out refied. So some of that's demonstrated here. But what we're looking at here is, and in year 9, so at age 38, this person has a net worth of $1.19 million, and they might actually be having other investments elsewhere, because also at that time frame at year 9, they are going to be generating $6,884 of extra cash flow from real estate investment, and so that's going to continue to grow. And then in year 10, it drops down. So again, this is as you're doing another real estate purchase, borrowing against your policy, so your cash value goes down. But you've purchased a real estate property, and then you're doing your rehab, and you cash out refi and do whatever it is that you want to do with that. So again, I mentioned earlier, we have this column where we are doing this cash out refi in excess of the interest charged by the insurance company. So these funds, you might reinvest those elsewhere, do other things with it. We're not even considering these funds in what we're doing. So it would be good to probably reinvest those elsewhere, or do other things, maybe extra real estate purchases as you're saving those. So that is the scenario of becoming a millionaire in basically 9 years with using the net wealth finance strategy. And in year 21, I had mentioned we are going to start borrowing against our policy. There's a good reason for borrowing against the policy rather than withdrawing. There is the potential for arbitrage. So we can borrow at 5%, but the policy can continue to earn, at that 6%. We looked earlier about the historical rate of return of the index being 6.15. I think the products have actually improved. So we could probably see the indexed policies doing slightly better than that. So that's why it's better to just borrow against the policy and continue to have that opportunity to arbitrage, where you have the accumulation value continuing to earn while you are generating or borrowing and generating income for maybe your stage of life where it's financial independence. And this is an amount that is tax-free since we're borrowing against the policy and not withdrawing it. We do have the ability to withdraw up to our tax basis, so the amount of premiums that we've paid in, we do have the ability to do that as well. So, but in this case, we're looking at borrowing against the policy, letting it continue to grow, and generating income for the rest of our life. We're showing it being a steady income stream. So this is an amount that we can draw for the rest of our life. We could tweak that. If you want to see a different scenario for your circumstances, drop a comment below with what you might want to target in your retirement. But this is just for illustrative purposes based on this individual who's funded this policy at $48,000 a year. So the $223,000 in this case, almost $224,000 being the amount that is drawn for the rest of this person's life, and this becomes an income stream that can be used and continue to grow wealth. Maybe the person still is working. This is showing sort of financial independence and retiring at age 50. So this is something that this person might do and then choose to do whatever they want to do. And at that age, they will be generating total cash flow of $322,000 when considering the real estate cash flows. And we can go down further. So if we go to, let's just say, normal retirement age, age 67 is maybe where they might start drawing their Social Security at this point. So we will be looking at $631,000 of total cash flow when considering this $400,000 in the real estate cash flows. So again, that will continue to rise because the asset values will continue to rise, and based on a 6% cap rate, that cash flow is going to continue to rise. So rents will rise over time as they always have. So really, that's why this is an extremely powerful strategy. And when you consider for all of the factors of how this doesn't have to be done alone, if you do the BRRRR strategy of real estate investment and use net wealth finance to generate your wealth, you could be saving elsewhere, doing market investments, doing a Roth. We love the Roth. Those are things that could be additional to this. Maybe if your income's slightly higher, if your savings rate's slightly higher, those things can be considered in addition to what you're generating through this policy. So I hope this content was informative. Maybe you learned something. Would love to hear whether or not we missed anything, whether you think there's items that you'd like to see us go over, other scenarios. Again, drop a comment below. But you're also welcome to book a meeting with us, and I would recommend starting with booking me first. My name is Carlo, the netwealthfinance.com/calendar, or you could scan this QR code on your screen to book a meeting, and we could discuss how you could implement this strategy for your own scenario. We work with various folks from all kinds of different backgrounds. If you're an entrepreneur, maybe a real estate investor, this strategy really can help anybody to build wealth faster. And if you're interested, you could also check the video description. We'll have links to our calendar and our website to learn more about this powerful strategy. Would love to hear from you. Thanks for watching. Check out some of these other videos up here, and we will see you on the next one. Thanks for watching.